我是一个9年亏了小400万的傻逼散户。
I've been a small investor for 9 years, losing almost 4 million yuan. It's more accurate to call me a chive, plump, naive, and quick growing. Never afraid to keep pushing forward, never giving up. I got into stocks in June 2015, and after 9 years, I've tallied a loss of 3.9 million yuan in stocks and funds, nearly hitting the 4 million mark. Just yesterday, I sold all my stocks, and today I withdrew all my money. Reflecting on these 9 years, I feel both regret and remorse. After withdrawing my money today, I couldn't calm down for a long time. I feel it's necessary to share my painful experiences and the harsh lessons I've learned in a video to those currently struggling in the stock market and those dreaming of making a fortune by entering it. I want to warn everyone with my own story, without any deceit. Don't speculate on stocks. Don't buy funds. Just don't do it.
This year, stock markets around the world are hitting new highs, but China's A-shares remain sluggish. The reason? A-shares in China are more about making quick money for the issuers than genuine market growth. They use the stock market as an ATM, cashing out after high-priced offerings and leaving small investors holding the bag. Since the Shanghai Composite Index peaked at 3,174 points on May 20th, it has been on a downward trend, breaking below 3,000 points on June 21st. Just today, the A-share market started low and kept dropping, with all three major indexes falling by more than 1%. At the close, the Shanghai Composite Index was at 2,963 points, with trading volume under 7 billion yuan. Less than 400 stocks rose and nearly 5,000 fell. Even with the Chinese government or central bank stepping in to buy shares, the A-shares continue to plummet. The transaction volume in A-shares has been dwindling, hovering around 700 billion yuan recently. For comparison, Nvidia's recent daily trading volume is around $70 billion, roughly 500 billion yuan. If you include Apple, the daily trading volume of these two companies alone could match the entire A-share market in China. Over the years, the Chinese stock market has continually disappointed investors, wavering around the 3,000-point mark since it first reached it in 2007. Even when it occasionally climbs to around 4,500 to 5,000 points, a market crash inevitably follows. For the past 17 years, the stock market has fought over 50 battles to reach 3,000 points. But even if it managed to reach it, what's the point? The root cause of the relentless decline in the Chinese stock market is the collusion between the Chinese government and the unscrupulous companies to deceive investors. They treat investors like chives, harvesting them over and over for more than 30 years. With the stock market barely alive and no more chives left to harvest, even the government experts are getting anxious, encouraging even farmers to join in stock trading. Just the other day, an expert published an article on today's headlines, urging farmers to invest in A-shares to become rich. This has been met with overwhelming opposition online, with comments like, "Now they've turned the scythe on the farmers," and "Desperate for new suckers? Now roping in farmers?" Financial commentator Peng Haizhou mentioned on June 20th that encouraging farmers to trade stocks is a harmful suggestion. Indeed, the topic of farmers trading stocks often comes up in discussions. China has 800 million farmers who make up the majority of its population, yet they are unrepresented among investors, who are mostly urban residents. So, expanding the investor base often involves targeting farmers. Peng Haizhou said that luring farmers to invest in A-shares under the guise of becoming rich is a deceptive practice, given that the A-share market has long prioritized financing over investor profit. It's hard for investors to make money there. In such a market, even experts often face losses. How can farmers expect to get rich through stock investments? It's clearly a deception. If farmers really invest in A-shares, how many will end up impoverished? Recently, some data showed that while there were 220 million accounts opened in the A-share market, only about 50 million people are currently holding positions. This means that only about 22% of account holders are active, which is really low. This number even includes accounts that are deeply stuck or inactive. If we only consider active accounts, the percentage might not even reach 10%. Professor and PhD advisor from a top Chinese university, Li Kongyue, is the chief economist for EDP Education Alliance. He recently talked about the 3,000-point defense battle in the Chinese stock market, saying it has taken advantage of several generations of investors, and now nobody is into stock trading anymore.
Do you think the stock market can still go up? With no one left, no more chives to cut, and younger generations not believing in earning from stocks. How can it rise? My son knows this. He was aware I was trading stocks when he was in elementary school. I started trading in 1993, and he was born in 1996. When he was in elementary school, the stock market was at 3,000 points. It was the same when he was in middle school, high school, after graduating from college, and after his master's. Now, 2 years into his job, it's still at 3,000 points. If you tell him stocks can make money, he wouldn't believe it, and neither would the younger generations.
Regarding the current situation, where the A-share market is struggling around 3,000 points again, Zhang Cheng, the chief investment advisor at DC Funds, recently told ChinaTimes.net that the recent trading volume in the A-share market has been maintaining around 700 billion yuan, and the sluggish trading volume also shows that external funds are reluctant to enter the market. With no new funds entering, the market continues to decline. The 3,000 point level is just a psychological threshold, and is expected to continue fluctuating around this point. More so than specific levels, when the market volume will increase is more critical. In recent years, several international capitals and mainstream funds have announced their exits from the Chinese market. This includes well-known names like BlackRock, Morgan Stanley, and JP Morgan, who initially came to China to share in the so-called reform dividends, but ended up being devastated by losses and eventually fled due to the long-term losses in A-shares. In addition to these examples, the world's second-largest sovereign wealth fund, Norway's Norges Bank, has closed its Shanghai office in China. Vanguard, the largest mutual fund company and the second-largest fund manager globally, also announced its exit from the Chinese market. Furthermore, Canada's second-largest pension fund, CDPQ, has shut down its office in China. Even the Wall Street Journal, once optimistic about the Chinese market, has published an article claiming that the Chinese stock market is a well-orchestrated scam that has caused millions of investors to lose confidence. Taiwanese chief economist Wu Jialong believes that Beijing is trying by all means to stabilize the stock market, but undoubtedly, restoring confidence is essential. The sources of this confidence primarily include stable policies and promising economic prospects, without constant, unnecessary disruptions. However, the problem lies in the Chinese Communist Party's dominance, leading to continuous new regulations for the stock market, which only seems to create more chaos. In 2024, a notorious fraud case involving the Chinese stock market was exposed. As of May 8th this year, the share price of ST Meishang had closed below 1 yuan for 20 consecutive trading days, triggering delisting conditions. Consequently, the stock exchange decided to terminate the listing of Meishang shares, which were suspended on May 9th and eventually locked at 0.13 yuan per share, a 99.9% drop from its historic peak, which is a total market value of 87.66 million yuan. By the end of March this year, over 20,000 shareholders were deeply trapped in this stock. Meishang Ecology was listed on the growth enterprise market at the end of 2015 with an issue price of 31.82 yuan per share and initially soared to 45.82 yuan. On April Fool's Day in 2016, its share price even spiked to a historic high of 153 yuan. However, 5 years later, in May 2021, Meishang was given a special treatment, an ST designation, due to suspected fraud and other issues. Recently, it has been widely rumored that Wang Yingyan, the founder of Meishang Ecology, has acquired Singaporean citizenship and fled with a huge amount of money embezzled from the public company. In response to inquiries from regulatory authorities, Meishang bluntly stated, "Our listing was fraudulent. Everything was fake." A post on Weibo allegedly made by senior executive of Meishang has caused a stir online. "My family and I have migrated to Singapore. Come and catch me if you can. Without insiders, how could we cash out? Your system is built on fraud, and we just took advantage of it. We forged our listing materials. Everything was fake." Meishang Ecology can be considered one of the most brazen companies in the history of China's stock market. Investors have commented that Meishang is among the worst of scoundrels in the realm of fraud. So, how could Meishang dare to be so blatantly fraudulent? Netizens commented on Weibo. Many say stock trading has turned into a national and familial grievance. Is the actual controller of Meishang despicable? Yes, but even more despicable are the related law enforcement agencies and departments in power that enabled it. Who audited them? How were they audited? Who sponsored their listing? How was it done? Who approved the listing? How was it approved? With 9 years of continuous financial fraud after listing, how did the Securities Regulatory Commission supervise? Such fraud cases like Meishang could only occur in China. In fact, the Chinese stock market is riddled with companies seeking to go public through financial fraud, and of course, many encounter financial issues after listing and resort to deception to cover the truth. In April 2019, Kongmei Pharmaceutical, then known as a 100 billion yuan quality stock, shocked A-share investors with a major scandal. The company announced that the 30 billion yuan reported in its 2017 financial statements did not exist. Soon after, Kongmei Pharmaceutical's financial fraud was confirmed. Public reports have shown that Kongmei Pharmaceutical had a long history of fraud, and various official departments played a protective role throughout its history. The issue with Kongmei Pharmaceutical is a long-standing problem in the A-share capital market, but it is not unique to Kongmei alone. Many companies are able to list with the backing of intertwined political and commercial interests, so A-share regulation primarily serves the elite capital, not protecting the interests of small and medium investors. Not long ago, it was discovered that Jinzhou Harbor, a listed company, had committed financial fraud for 4 consecutive years, totaling an amount of 86 billion yuan. On June 3rd, the company's stock was suspended for a day, and upon resumption on June 4th, it was labeled ST, Special Treatment. The sudden revelation stunned nearly 100,000 shareholders. From 2018 to 2021, Jinzhou Harbor and related companies inflated their revenues, costs, and total profits through fictitious trade operations, leading to false reports in annual reports from 2018 to 2021. The company was fined 8 million yuan. Professor Sun Guoxiang from Southern University's Department of International Affairs and Business in Taiwan stated that such incidents are indicative of weak internal controls and an incomplete regulatory system. The laxity of external regulation stems from the same issue. Since it's a party-led country involving state-owned enterprises connected through intricate political and business networks, even if there are Western-style laws and regulations, their enforcement is not fully effective, leading to insufficient deterrence. According to unofficial statistics, since 2023, a total of 205 listed companies have been fined for false or misleading information disclosure. Many have criticized China's securities market for its systemic flaws. Established in 1990, the primary purpose of China's securities market was to finance state-owned enterprises. Among the over 5,300 listed companies, nearly 1,500 are state-owned or central enterprises. Later, a large number of private enterprises were allowed to exist, and the existence of the Chinese stock market has been described as a funding market for companies. Chinese financial scholars harshly criticize 4 persistent problems in the A-shares market: financial fraud, the design of the new stock IPO financing system, securities lending, and quantitative trading. They believe these design flaws enable companies and investment institutions to irresponsibly profit at the expense of individual investors, ultimately leading to a continuous decline in the stock market. Moreover, after the main boards of the Shanghai and Shenzhen stock exchanges included a registration system, more disreputable companies have been able to list on the A-shares market. Since the China Securities Regulatory Commission, CSRC, shifted from an approval system to a registration system for IPOs on February 17, 2023, several companies have shorted their own stocks upon listing. A clear example is Golden Empire, which sold 4.7 million shares through securities lending on the day of its listing in September 2023. Financial fraud is described as a cancer in mainland China's capital market, with companies committing fraud through the IPO and refinancing stages and submitting false financial data during the issuance reporting phase. The primary methods of financial fraud include fabricating business and contracts. Chinese investors criticize the CSRC for ineffective regulation, even accusing it of collusion. They say they are responsible for listing companies and pretending to address issues, stuffing their pockets until the bubble bursts. They are responsible for delisting problematic stocks, putting them under ST status first, leaving investors to foot the bill, while imposing fines and leaving investors with nothing. After the IPO process transitioned to a registration system on February 17, 2023, the CSRC witnessed several companies shorting their own stocks immediately after listing. The example of Golden Empire shares is particularly notable. David Huang, an overseas Chinese economist, notes, China's IPOs and fundraising practices differ from international markets. They often involve deception and hype. After the pandemic, while most global economies saw their stock markets rise, China's performed poorly. The main reason is the excessive public offerings constantly entering the market to cash out, draining existing market investments. The overall capacity of China's investment market has declined, whether it's public or private funds or ordinary investors. The overall financial situation in China is dire. Continuing to bleed the market will inevitably be a significant bearish influence and is unhealthy. Huang believes a major issue with the Chinese stock market is unclear regulation, and most listed companies become enabled to slaughter in the stock market. This listing often involves rent-seeking by those in power, financial fraud, and various speculative themes. The regulatory bodies exist, but are plagued by systemic issues and corruption, with officials appointed based on promotions rather than capability. Often, listed companies may have relationships with regulatory leaders or act as their proxies. Some companies exhibit high levels of financial statement fraud, and regulators often engage in interest transfer and rent-seeking with listed companies, which perpetuates the problem of weak regulation. Moreover, the securities lending and quantitative trading short-selling systems in the A-share market are hated by investors. Securities lending is a mechanism where securities firms use A-shares as collateral for low-interest loans to the securities market. Institutions borrow shares to sell short and then buy them back at a lower price to profit. Additionally, with most of China's market investors being individual traders, the widespread use of quantitative trading has made their situation even more difficult. The relentless downturn in China's stock market has left many individual investors in despair. Professor Liu Dipeng, former dean of the Capital Finance Institute at China University of Political Science and Law, strongly advises against casual investing in this market. He said at a forum,
In just over 30 years, China has adopted the world's most sophisticated short-selling mechanisms, executing 300 transactions per second. This high-frequency and quantitative trading is a core issue. It's unfair. 95% of individual investors don't have access to such tools. Who can short sell with securities lending? Yes, there are restrictions. Controlling shareholders cannot sell their shares in the secondary market until the restricted shares are released. However, they can now use securities lending to illegally reduce their holdings. This ongoing issue, why can't it stop even today? Everyone knows that the securities lending mechanism is managed by a company under the China Securities Regulation Commission, the China Securities Finance Corporation. So why not address this primary conflict first and consider putting a stop to the injustice?